More now on those Walmart earnings that were released earlier today. The world's biggest retailer beat the street by 3 cents, earning 98 cents a share, but sales at U.S. stores open at least a year dropped for the 8th quarter in a row. That top line has been painful for them. At a time when consumers are still struggling, why can't the discounter dominate? Let's ask Craig Johnson, president of Customer Growth Partners. Craig, welcome to the show.
Hi, Margaret.
So this should be right in Walmart's playbook. They're the discounter. They're great at pushing prices down at a time of economic duress. Why can't they grow that top line?
Well, they have a couple different problems. Some of them are long-running problems. Apparel's been a problem for a long time. Home has been a problem. But they're getting hammered from a couple different points of view. Obviously, their core consumers are very, very troubled right now with the economy. But they're losing sales at the bottom end to Aldi, places like Aldi and Save-A-Lot at Super Value. They're losing sales there. And they're affected by what has been a great growth engine for them, consumer electronics, people migrating off of consumer electronics from buying it in stores to buying it on the net. So they're getting Amazon the same way Best Buy is.
Why would they be losing market share to other discounters? Is it geographic location? Is it that Walmart's not aggressive as they used to be on pricing?
Well, they're pretty aggressive on price. Actually, Target, by our surveys, was lower priced than Walmart on a market basket of 55 items for the first 3 months of the year. Walmart has recaptured that with more price aggressiveness over the last month or so. But they're losing it because places like Aldi are about 14 to 50% less expensive even than Walmart. And Aldi makes a point of locating itself. Its location criteria is across the street from a Walmart supercenter or within a half a mile.
So is it, I mean, half of Walmart's sales now are in the food category. They're the biggest grocery store out there. We all know about food inflation. So is it that part that is really difficult for them?
Well, they are getting hammered by food inflation. Their consumers are. Both food and energy inflation are crushing them domestically. But actually, food is a little bit of a booster. Their same-store sales numbers would have actually been worse if not for the food inflation we've seen this year to date, which actually, oddly enough, helps them a little bit.
Well, on the ticket, growing the ticket. Yeah. With what they've been doing just in the past month and a half, we've seen some interesting acquisitions in the social media space. Yeah. They acquired Cosmetics, and then in China they made a partial purchase of a Chinese online retailer. Yeah. Are they reshaping themselves here a bit?
Well, they're trying to, but that's really just nibbling at the edges. Yeah. That isn't addressing really what has been one of the core problems. They have a fleet of stores, these almost 200,000 square foot stores, these superstores that were built for yesterday's retail wars. And right now, people want the low prices, but they also want convenience. They want location and convenience, and that's why their customers are migrating to these smaller format stores. And so they've announced in a trialing some new stores that they'll be opening up as the year goes on, those new small format stores, but they're late to the dance on that. They should have been doing that 2 or 3 years ago.